You spent a decade in training. You delayed everything: income, family, life to build something real. And when you finally sell that practice or that building, the IRS shows up and take more than a third of it. Not because you did anything wrong, because nobody told you what was actually happening at the asset level. Most physicians think capital gains is one number, 15 or 20%, but it's not. For someone at your income level, is five separate layers stacking on top of each other. And by the time most doctors find out, the transaction has already closed and the options are gone. Think of it like a patient who waited too long. The underlying condition was building up for years. By the time it's symptomatic, the best interventions are already off the table. I'm Dr. Taxter, an EA with a master's in taxation who works exclusively with medical professionals. Today, I'm going to show you what actually triggers your capital gains bill and how big it can really get, and the strategies straight from the tax code that can reduce, defer, or eliminate it entirely, but only if you plan before the event, not after. So, what creates your capital gains bill? Capital gains don't appear out of nowhere. Something has to cause them. In tax law, we call these taxable events. For physician and dentist, the four most common triggers are: 1. Selling your practice, 2. Selling real estate, 3. Selling appreciated stock or private equity, and 4. Liquidity event from hospital system equity or partnership buyout. Think of a taxable event like a precipitating factor in a patient's chart. The appreciation has been building for years, silently, like a chronic condition. The sale is a trigger that makes it symptomatic. You've seen a patient with a massive ascites. By the time the belly is that big, the liver is already fried. The window for the best interventions are gone. Here's what makes this especially dangerous for physicians. Most of your income producing years happen in a compressed window. You finish training in your early 30s, you spend the next 2 or 3 decades building and accumulating. And then at one moment, a sale at the peak of your career or at retirement, all of that accumulated gain becomes taxable in a single calendar year. And the IRS doesn't spread that out for you. The moment the trigger fires, the question is simple: how much do you owe? And for someone at your income level, the answer is a lot more than most people expect. So, this is where I see the biggest disconnect. Physicians think capital gains tax is one thing. It's not. It's five separate layers stacking on top of each other, and each one applies to you. Think of it like a patient presenting with a chest pain. You're not dealing with one problem, you're dealing with uncontrolled diabetes, hypertension, atherosclerosis, a smoking history, all at once. Treat just the chest pain and you miss the case. That's exactly what happens when a physician only accounts for the headline rate and ignores what's underneath it. So, layer number one: long term capital gains, 20%. At your income level, you're not in the 15% tax bracket. You're likely at 20%. Not 15, not 0, 20. Layer number two: net investment income tax, 3.8%. It is an automatic surcharge once your income exceeds $200,000 for single or $250,000 for married taxpayers. Nearly every physician I work with crosses that threshold. Layer number three: depreciation recapture, up to 25%. If you own real estate and taken depreciation deductions, the IRS want those back when you sell, tax under what's called unrecaptured 1250 gain. Layer number 4, cost segregation recapture up to 37%. If you did a cost segregation study to accelerate deduction, that depreciation gets reclassified into personal property. When it's recaptured, it's not at 25%. It's at your ordinary income rate. So the cost segregation saved you money in year one. It silently increased your liability at sale. Like a treatment that worked up front, but created a serious complication on the back end. Layer number 5, state income tax. California adds up to 13.3%. Washington has no income tax, but it has a 7 to 9.9% capital gains excise tax above its deduction threshold. Simple math, a $2 million gain, federal capital gains at 20% is $400,000. Add net investment income tax, another $76,000. Add depreciation recapture, another $50,000 to $100,000. Before state taxes, you're looking at $500,000 or more in a single year. That's a bill. And it's entirely preventable, or at least significantly reducible, if you're planned before the event, not after. There are 3 categories of strategies I want to walk you through. The first one is direct exclusion. Strategies that eliminate the tax entirely. Poof, gone. So in medicine, this is the cure. No symptom management, the gain disappears. So strategy number 1, primary residence exclusion under Section 121. So and own and live in your home for at least 2 of the past 5 years, and you can exclude up to $250,000 of gain if you're single, and $500,000 if you're married. For physicians who bought early and have seen real appreciation, this is one of the cleanest exclusion in the code. No deferral, no carry forward, gone. Strategy number 2, qualify small business stock, Section 1202. Invest in a domestic C corporation with less than $75 million in asset, hold for more than 5 years, and you may be eligible to exclude 100% of the gain, up to $15 million. This applies to early investment in medical tech companies, healthcare platforms, or similar ventures. Think of it like a vaccine. It only works if you administer it before the exposure. So the structure has to be correct from day one. Extremely difficult to plan retroactively. Strategy number 3, basis adjustment at death under Section 1014. If you hold appreciated property until death, whether it's real estate or practice or stock position, the basis resets to fair market value at the date of death. So every dollar of gain accumulated during your lifetime vanishes from an income tax standpoint. So your heirs inherit a clean slate. This is sometimes called a death strategy. And yes, it sounds extreme, but it's actually part of the playbook. Think of it like watchful waiting in medicine. Sometimes the best intervention is a deliberate non-intervention. In ER, we say, don't do something, just stand there. So defer and borrow against the asset for liquidity and never voluntarily trigger the sale. So a physician holding a $3 million building with a $500,000 basis eliminates a $2.5 million gain and several $100,000 in tax simply by holding. The second category is deferral. These strategies don't eliminate the tax, they delay it. If exclusions are the cure, deferral is well managed chronic disease. So you're controlling the liability, timing it, and preventing it from doing damage at the worst possible moment. Strategy number 1, like-kind exchange under Section 1031. Sell investment real estate and reinvest the proceeds into another qualifying property within 180 days. You defer the entire capital gains and all depreciation recaptures with it. The gain carries into the new property. The IRS doesn't get paid until you eventually sell without exchanging, which many investors never do. Three things physicians get wrong on 1031 exchanges. First, you have to identify the replacement property within 45 days and close within 180. The clock starts at closing, no extensions. Think of it like a EVAR window for an abdominal aortic aneurysm. You miss it, and the option is dead. Second, you can't just roll over the cash. If you sold $1 million property with a $800,000 loan, you have to replace the full value and the debt, not just $200,000 equity. Partial reinvestment means partial gain recognition. Third, it must be properly reported on Form 8824. If it's not on the return correctly, the IRS treats it as a full taxable sale. Strategy number 2, qualified opportunity zones under Section 1400Z-2. Reinvest a realized gain into a qualified opportunity fund within 180 days and defer the original capital gain. More importantly, any appreciation on the qualified opportunity fund investment itself may be completely tax-free if you hold for at least 10 years. So here's a concrete example. $500,000 of capital gains from a practice sale goes into a qualified opportunity fund. That investment grows to a $1.2 million over 10 years. The $700 of new appreciation may be entirely tax-free. That's not a loophole. That's how the statute is written. Strategy number 3, installment sale under Section 453. Structure the sale so that the buyer pays you over multiple years. You only recognize a proportional gain in each year you receive a payment. This is a tax equivalent of multi-fraction radiation treatment. You're spreading the burden over time instead of absorbing it all at once. It can keep you out of the top tax bracket in a single year and push recognition into retirement years when your total income is lower. Common in physician practice sales and often negotiable with buyers. Strategy number 4, ESOP under Section 1042. For physicians who own a closely held C corporation practice, you can sell your stock to an employee stock ownership plan, ESOP, reinvest the proceed into qualifying domestic securities, and defer the entire gain. It's complex, but for the right structure, the deferral can be substantial. The third category is charitable and trust-based strategy. Physicians tend to be philanthropically inclined, and these structures let you give generously while eliminating capital gains at the same time. Think of it as a combination therapy. Two goals, one well-structured plan. Strategy number 1, donate appreciated stock directly. If you plan to give to charity anyway, never sell first. If you sell and donate the cash, while you can get a deduction, you will have to pay capital gains. So instead, donate the stock directly to the charity. The charity receives full value and you avoid the capital gains entirely. And you may also still get a deduction for the full market value. Nothing changes about your charitable outcome. You're just optimizing your tax outcome. A donor advised fund makes this much easier. Contribute the stock, take the deduction in the year you contribute, then direct grants to your chosen charity over time. Clean, flexible, available to almost everyone. Strategy number 2, charitable remainder trust, CRT. Contribute the appreciated asset to a CRT. The trust sells it without paying capital gains tax. It reinvests the full proceeds and pay you an income stream for life or a fixed term. You receive an immediate partial charitable deduction, and at the end, the remaining assets go to a charity you've named. So instead of selling a $3 million building, paying $600,000 in taxes, and investing $2.4 million, you contribute it to trust, and the trust sells with no gain and invest the full $3 million and pay you income from a large asset base for years. So you're not losing the money, you're changing how it flows to you in a way that is dramatically more tax efficient. For this one, I will talk to my dear friend, Dr. Klaus Gottlieb. He's an MD, estate attorney, who specializes in the CRT space. Strategy number 3, UPREIT under Section 721. So contribute real estate to the operating partnership of a REIT in exchange for partnership units. No gain at contribution. You get diversification and liquidity over time, managing the tax recognition on your own timeline as you convert units to REIT share. So here's a framework. If you're a physician or dentist, this will feel similar. It maps directly onto how you work up a complex case. So step number 1, history and physical. Identify your trigger. What appreciated assets do you hold? A practice, a building, stock, private equity. When do you expect to sell or transfer them? You can't form a plan until you know what you're working with. Step number 2, full diagnostic workup. Understand the layers of tax each asset would generate, not just the capital gains rate, including net investment income tax, depreciation recapture, state taxes, and the character of any accelerated depreciation taken. A physician who reads only the chief complaint and skips the lab and imaging studies has missed the diagnosis. Same here. Step number 3, differential diagnosis. Match the strategy to the situation. Exclusion when you qualify outright. Deferral when you need to move capital and control the timing. Charitable strategies when philanthropy is already part of your goals. Don't apply the same protocol to every patient. Don't apply the same strategy to every asset. Step number 4, implement before the event, not after. A 1031 exchange can't be backdated. An installment sale can't be restructured after you've received the cash. A charitable remainder trust can't be funded with proceeds you've already received. In medicine, the best time to prevent a complication is before it occurs. In tax planning, the same principle applies with no exceptions. This is the single most important thing I want you to take from this video. Planning is a pre-event activity, not post-event one. So here's a bottom line. Your income is already near at the top of the tax bracket. Your assets are concentrated. Your exit events are significantly and compressed into a short window. A poor planned sale don't cost you a little. It can cost you hundreds of thousands of dollars you earn over decades of work. The physicians who keep the most aren't necessarily the one who earn the most. They're the one who treated their financial health the same way they treat their patient. With a complete workup, a clear diagnosis, a plan implemented before the condition became a crisis. It's not about getting the deduction. It's about understanding what triggers a liability and structuring around it before the trigger fires. The people who win are controlling when the gain is recognized, when the recapture shows up, and when the IRS gets paid, and most importantly, when it doesn't. I'm Dr. Taxer. I see you in the next one.